Good afternoon, everyone. Welcome to the American Academy of Actuaries virtual briefing on the effects of COVID-19 on 2021 health insurance premiums. I am Audrey Halverson, the Academy's Vice President for Health, and I'll be moderating today's webinar. Each year, the Academy puts out an issue brief that provides an overview of the drivers of the next year's premium changes. We focus on the premium changes for individual and small group market coverage that is subject to Affordable Care Act rules. The COVID-19 pandemic has introduced new uncertainties into the development of premium rates for 2021. This year's issue brief and today's briefing focus primarily on the impact of COVID-19 on the 2021 premium rate filings. I will cut to the chase. How COVID-19 will affect 2021 premiums depends on assumptions related to the persistence of the first COVID-19 wave and emergence of subsequent waves in 2020 and 2021, shifts in insurance coverage and risk pool composition, COVID-19 testing and treatment costs, vaccine availability and costs, and other changes to utilization and costs, including those related to telehealth and provider reimbursement rates. The Academy also recently released an issue brief on mechanisms that are designed to reduce risks to health insurers, such as risk corridors and reinsurance. The issue brief describes these mechanisms and assesses their ability to mitigate the heightened risks and uncertainty that insurers face due to COVID-19. Today, I'm joined by two actuaries who are involved in drafting our issue briefs, Barb Cleaver and Corey Uccello. Barb is the chair of the Academy's Individual and Small Group Markets Committee. Corey is the Academy's Senior Health Fellow. Barb will discuss the effects of COVID-19 on 2020 premiums, and Corey will discuss health insurance risk mitigation mechanisms. The webinar is scheduled to last an hour. The formal presentation should last about 40 minutes or so, leaving us plenty of time for Q&A. We'll hold all questions until the end. But please feel free to submit questions throughout the presentation using the Q&A feature on your screen. We'll try to answer as many questions as possible within the time allotted. With that, I'll start by providing some context. 2021 rate development is based on 2019 claims experience that is projected forward to 2021. That 2019 experience won't reflect the extent of the pandemic, so actuaries will need to determine whether and how to make adjustments when projecting it forward to 2021. Insurers will likely run multiple scenarios involving different assumptions regarding the effects of COVID-19, including those related to future COVID-19 waves, deferred services, and vaccine availability. There is a lot of uncertainty regarding these assumptions, and greater degrees of uncertainty could lead to more conservative assumptions and risk margins. Preliminary rate filings are already being submitted to states and the federal government for review. Final rates are due to the federal government by August 26th for federal exchange states and October 15th for state exchange states. Premiums reflect several factors. The main component is projected medical spending, which in turn reflects who is covered and the composition of the risk pool. Other premium components include administrative costs, taxes, and profits. Laws and regulations can affect each of these components, as well as how premiums vary among individuals. As we'll hear in more detail, COVID-19 has affected many of these components. With that, I'll turn things over to Barb, who will cover the major premium drivers for 2019.
Thank you, Audrey. The COVID-19 related premium drivers apply to both the individual and small group markets, and many of the drivers apply similarly to both markets. However, there is one important difference in the rating rules between the individual and small group markets. The small group market may have rate changes filed quarterly, which means that insurers can update assumptions as more information becomes available. But the individual market has annual rates that apply for the calendar year, so issuers must make their best estimates this summer by their state's rate filing deadline for their entire 2021 individual block of business. There are several components to the COVID-19 related drivers of premium changes that I will be going over in this presentation. As mentioned earlier, rate development for the individual and small group markets for 2021 starts with 2019 claims experience and trends it forward 2 years, accounting for cost and utilization changes, changes in demographics and morbidity, and other coverage-related impacts. Issuers look at their 2020 year-to-date experience in order to determine the appropriate trend factors to apply to the 2019 experience. COVID-19 has significantly impacted 2020 experience, and issuers have been monitoring the impact on claims in 2020 and projecting the impacts forward throughout the rest of 2020 and into 2021. Issuers are also considering the impact of the current economic conditions on the risk pool, with the current high unemployment rates and losses of employment-based coverage, which could lead to changes in enrollment and morbidity in the markets. Treatment and testing costs for 2021 must be considered, especially the possibility for new treatments and vaccines. Other factors that could impact healthcare utilization and costs include the impact of deferred and eliminated care due to the pandemic, changes in provider reimbursement rates, and the increased use of telehealth. In addition, there are state considerations that I will go through later in this presentation. First, I will discuss some of COVID-19's effects on 2020 health spending. In terms of the cost of treating COVID, it has resulted in some high-cost hospitalizations. The total cost of treatment depends on the percentage of the population that is infected and the percentage of those who are hospitalized. A fairly low percentage of infected individuals need hospitalization, but a portion of these require very intensive treatment. In addition, insurers are required to waive cost sharing for testing, and some insurers are waiving cost sharing for treatment during the emergency period. Social distancing and the need to free up space for COVID-19 patients resulted in reductions in non-COVID care beginning in March. Even emergency room utilization for serious conditions decreased, possibly due to people being concerned about contracting the virus in the emergency room. Expanded availability of telehealth has filled in some of the gaps, but telehealth can't replace many services, such as revenue-generating elective surgeries. The decrease in non-COVID services occurred across the nation, not just in areas hard hit by COVID, due to the nationwide lockdown. But for the rest of 2020, resurgence of COVID in certain areas may lead to less deferral and reduction in services than we've seen in the last 2 months. Dr. Fauci said recently that the country would not need to return to a widespread lockdown, but certain areas may need to go back to an earlier phase of reopening. There is evidence that elective care is returning. It is likely that there will be state and local variations on when medical providers may begin offering the full range of non-COVID services. The COVID pandemic has had less impact on prescription drug spending other than insurers seeing more 90-day prescriptions. If people, however, continue to not go in to see their doctor, there could be a reduction in prescriptions written. It is unclear on how the trends will continue in 2020 and whether deferred care will take place later in 2020 or 2021. The timing depends on the level of the virus in any particular area. If the care is later provided in 2021, then 2021 claims will be affected, and there could be additional demand for services in 2021, which would lead to an increase in needed rates. One of the main considerations in setting premium rates is the characteristics of the population expected to be enrolled. The individual market has traditionally had quite a bit of turnover because it is a market where people may gain coverage between jobs. But the current economic situation makes predicting the enrollment for 2021 even more difficult. We don't know how long the high unemployment environment will continue and what the level of unemployment will be next year. There are several types of enrollment shifts that could impact the individual market. First, there could be individuals losing employer coverage who qualify for the individual market, either with or without subsidies. However, many people who become unemployed may qualify for Medicaid rather than the individual market. This will vary depending on whether the state expanded Medicaid. There isn't a direct link between job losses and the number of people losing employer coverage. Many of the industries hardest hit initially had low rates of insurance coverage, either because they did not offer coverage or had low take-up rates of insurance by their employees. In addition, some people losing coverage through work can pick up coverage with a spouse's employer. Second, some individuals already in the individual market may have reduced means to pay for premiums and may drop coverage, or their income may drop enough to qualify for Medicaid. Due to these offsetting factors, it's possible that the size of the individual market will not change by a large amount, but the people within the market will be different than those previously covered and also included in the experience that the insurer is using to project future claims. The health status and morbidity of the people moving into and out of the market needs to be considered to estimate the resulting morbidity level of the pool. People currently in the employer market as a whole are healthier than the individual market, but when they lose coverage and become eligible for the individual market, they make a choice on whether to enroll, based on their expectations of their health and the cost of the coverage. In general, less healthy people tend to purchase coverage at a higher rate than healthy people, which leads to adverse selection. Insurers have experience with COBRA coverage, which also includes a choice on the part of the individual on whether to purchase coverage, and COBRA experience tends to have high claim costs compared to premiums. The COVID epidemic may provide more of an incentive for people to maintain coverage, though. People typically are not losing employment due to a health-related crisis such as COVID, but perhaps through an economic crisis. Since the employment coverage loss is due to an epidemic, there are thoughts that adverse selection may be lessened due to the greater value placed on insurance coverage. Now moving to the small group market, small employers are less likely to offer coverage than large employers currently. The ACA employer mandate does not apply. This economic downturn could accelerate the trend of lower enrollment in the small group market due to small groups dropping coverage, laying off workers, or going out of business. Insurers have noted in prior recessions that the people remaining in the small group market tend to be less healthy. Small employers tend to have greater knowledge of their workers' health care needs and retain coverage if their workforce includes less healthy people, whereas small employers with younger healthy workers or workers with access to other coverage may be more likely to cease offering coverage. Small groups subject to COBRA may have less healthy people sign up for COBRA due to job loss. The Department of Labor recently issued policies to extend the COBRA election period, which could exacerbate adverse selection in COBRA. We note that, as with the individual market, the nature of this economic contraction may increase the perceived value of health insurance and offset some of these effects. We've already discussed the uncertainty around the cost of treatment and testing costs for 2020. For rate setting, issuers need to project the cost of testing and treatment for 2021, which will depend on the level of infections that occur and when or if a vaccine becomes available. Insurers have information on COVID treatment costs during the first wave, but the costs could change in the future. For example, there could be new treatments, such as new drugs, and doctors may refine their treatment practices after more experience with the virus. There have been reports of other longer-term health issues faced by people after recovering from the initial COVID infection, so insurers may consider follow-up treatment costs when determining 2021 rates. The cost also depends on the mix of case severity. We know that the virus is generally more severe for older people. If the infections hit a younger population, the percentage of cases that need hospitalization could change. The availability and cost of a vaccine are currently unknown. It seems unlikely but possible for a vaccine late this year. Insurers need to consider the possibility of a vaccine becoming available in 2021, the percent of the population that will receive the vaccine, and the cost of the vaccine. Cost of testing will also be built into premiums. Insurance typically covers medically necessary diagnostic testing. Tri-agency FAQs were released this week that clarified the responsibility of insurers to cover medically necessary diagnostic testing ordered by a medical professional. There is a question of how testing that is not medically necessary is financed. Reopening the economy requires more frequent COVID-19 testing. Employers may need to frequently test employees until a vaccine is available. The FAQs clarified that health plans are not required to cover testing for public surveillance or for employment reasons. Other factors affecting 2021 healthcare utilization and costs include whether there will be pent-up demand in 2021. This could be due to services that were deferred in 2020. However, if COVID continues to occur in 2021, utilization could continue to be suppressed in 2021. However, providers can seek to increase capacity and have already been looking at ways to continue providing care while handling COVID patients as well. On the other hand, people may still be reluctant to seek out certain services if they are concerned about contracting the virus. Telehealth may help fill in the gaps. However, telehealth can't be used for all types of services. Some insurers are paying telehealth at the same rate as office visits during the emergency period, whereas it has typically been reimbursed at a lower unit cost. With increased use of telehealth, there are concerns about overutilization. Due to the convenience factor, it's much easier than going into an office, and also due to the possibility of needing additional visits due to the limited nature of services that can be provided via telehealth. There has also been concern about provider revenue. Some insurers are advancing payments to healthcare providers to help address short-term cash flow concerns. These are not meant to act as long-term loans and shouldn't have an effect on 2021 premiums. However, there are other factors that could lead to providers negotiating higher payments in general, which could increase 2021 premiums. For example, more Medicaid enrollment could lead to revenue decreases to providers, which they may need to make up by getting higher commercial reimbursements. In addition, certain specialties and types of practices are being harder hit with the utilization reductions. These types of providers may be more likely to seek higher reimbursements. The deferral of services may also lead to higher cost health care down the road. There have been concerns about children not receiving their vaccines on the normal schedule. Some chronic conditions could become more costly if not treated on a regular basis. And missed cancer screenings could lead to cancers being detected later and needing more intensive intervention. In addition, there may be increased behavioral health needs due to increased stress and substance abuse. The increased stress currently has been generated by the stay-at-home orders, the economic impact and job losses, and the increased burden on households with children with the daycare and schooling disruptions. Patients who have recovered from severe cases of COVID and have been on ventilators have shown signs of PTSD, which needs to be treated. Insurers assume that many of these impacts will continue into 2021 as long as the COVID situation is ongoing. The likelihood of MLR rebates for 2020 is higher given that rebates were required for 2018 and are expected to be required for 2019. And the MLR rebate is based on a 3-year average, so it will be based on 2018 through 2020 for the 2020 MLR. CMS recently released guidance on providing early 2019 MLR rebates. This guidance is specifically for insurers that will owe MLR rebates for 2019 that are currently payable by September 30th this year. Issuers are allowed to pay these rebates early under the guidance. However, if claims remain below expected for 2020, issuers may also have rebates for 2020 payable in 2021. Some insurers have already announced premium credits for 2020, typically in group lines of business or non-ACA individual. Rate credits or premium holidays would reduce these insurers' 2020 premium, which would also reduce their 2020 MLR rebate amount. There are some questions on the permissibility of doing rate credits and premium holidays for the individual ACA business due to the interaction with APTCs. MLR rebates have not typically been a large consideration in premium setting. that due to the better than expected experience over the past few years, issuers may take this into account to reduce the chances of paying rebates for the 2021 MLR year and reduce the conservatism in their pricing. However, this is only a consideration. Some insurers may decide to continue with more conservative assumptions and allow the MLR provision to provide for refunds if the rates end up being higher than experienced. The decision may depend on whether the insurer has competitive rates without reducing premium and on the risk appetite of the insurer. Issuers will take any state-specific guidance into account for 2021 rates. States have implemented various policies during the COVID emergency regarding use of prior authorization. Some states have extended grace periods and increased access to telehealth. In states with 1332 waiver reinsurance, if the program is funded on general assessments to insurers, the funding could be less than anticipated due to drops in enrollment in the employer market. This could lead to a decrease in the amount of reinsurance funding available, which issuers would need to take into account when setting rates. This would apply for state reinsurance that is set up similar to the ACA temporary reinsurance program, where the coinsurance rate was adjusted based on the funding available. So to summarize, COVID has introduced significant uncertainty in projecting 2021 claim levels. Earlier in the year, we would have expected the 2021 rating season to be very uneventful. While the individual market has had a lot of rating uncertainty in the past, it had lately become relatively stable, but COVID has changed this. The degree COVID will impact 2021 claims depends on the level of COVID infections in 2021, the costs of treatment and testing for COVID, which is offset by care that might be deferred or eliminated. In addition, issuers will need to consider shifts in enrollment between insurance markets and the impacts of these shifts on the individual and small group market risk pools. The availability and cost of vaccines will be factored into projections. Timing of this availability is very important and unknown. And changes to telehealth utilization and cost will impact the total cost of health care. Now I will turn the presentation over to Corey Uccello to discuss the risk mitigation mechanisms.
Thank you, Barb. As Barb noted, COVID-19 has introduced a great deal of uncertainty into the health insurance system and 2021 premium rate setting. Now, health insurance by its nature deals with risk and uncertainty. But if risks and uncertainty are unusually high, insurers could price more conservatively, resulting in higher premiums. And if insurers deem that the risk is too high, they could leave the market altogether. Now, COVID-19 doesn't appear to be resulting in insurers leaving the market, but it has increased uncertainty and the risks insurers face. This chart shows the kinds of risks that insurers face even in normal times. They face pricing risk, which is the risk that premiums are not adequate to cover claims, thereby causing insurer losses. Or premiums could be too high, resulting in windfall gains to insurers. Pricing risk can arise when uncertainty is higher than usual, and COVID-19 has increased pricing risk. There are different mechanisms to address pricing risk, including risk corridors, medical loss ratio requirements, and aggregate reinsurance. I'll talk more about these shortly. Another risk that insurers face is plan-specific adverse selection. That's the risk that an insurer's enrollees will have expected health costs that are higher than the market average. This kind of risk arises when insurers aren't able to vary premiums to reflect enrollees' underlying health status and can cause insurers to avoid enrolling high-cost enrollees. Risk adjustment is used to adjust the premiums that insurers receive so that they better reflect the enrollee risk profile, thereby reducing insurers' incentives to avoid unhealthy enrollees. As Barb mentioned, COVID-19 could affect plan enrollment numbers and risk profiles. If a particular plan is subject to more adverse selection than other plans in the market, the current risk adjustment program will help address that. However, risk adjustment doesn't help if the market as a whole experiences adverse selection. That's more of a pricing risk issue, which could be addressed by other mechanisms. A third risk that insurers face is enrolling individuals with particularly high healthcare costs. This can include individuals who would be expected to have high costs and also can be random, in other words, not known in advance, for instance, due to things like accidents or new diagnoses such as COVID-19. Individual level reinsurance is a tool that can address this kind of risk, and I'll talk more about that a little later. Okay, now I'll talk in more detail about risk corridors. Risk corridors could be used to protect insurers from COVID-19 related losses if claims experience is different from expected. And depending on how they are structured, risk corridors could also limit insurer gains. With one-sided risk corridors, the government would pay insurers if their losses exceed a certain threshold, for instance, 5% of claims. Two-sided risk corridors would also protect against very high insurer gains. The insurers would pay the government if their gains exceed a certain threshold. Two-sided risk corridors are used in the Part D program and were included during the initial years of the ACA in the individual and small group markets. Risk corridors would likely not have a major impact on premiums, but could allow insurers to reduce their risk charges and use less conservative pricing assumptions. Aggregate reinsurance, which I mentioned earlier, is similar to a one-sided risk corridor. Aggregate private reinsurance is available currently to private insurers and self-funded employer plans. And when it's for self-funded plans, it's typically referred to as stop-loss coverage. A typical aggregate stop-loss attachment point is 125% of total expected claims. Now, I know risk corridors can be a bit confusing, so I wanted to provide an example. This graphic shows a hypothetical risk corridor program and illustrates a two-sided symmetrical risk corridor. On the right side, we see that if actual claims exceed expected claims by more than 5%, the government pays 80% of those excess claims, but the insurer still bears all of the losses up to that 5% and 20% of the losses above that 5%. On the left side, we see that if actual claims are lower than expected claims by more than 5%, the insurer pays 80% of those excess gains. But the insurer keeps all the gains within that 5% threshold and 20% of the gains above that 5%. Now, for a one-sided risk corridor program, only the right side would be in effect. Insurers would get reimbursed for excess losses, but they would keep all of the gains. One-sided risk corridors don't protect against unanticipated insurer gains, but the medical loss ratio, or MLR requirements, can provide a backstop on insurer gains. And rather than a two-sided corridor, in which the insurer would pay the government for unexpected gains, under MLR rules, insurers would rebate a portion of the premium to the policyholder. MLR requirements are already in place in most insurance markets. They limit the share of premiums that goes toward administrative expenses and profits as opposed to being used to pay for health claims. If claims fall below a certain threshold, the insurer must refund a portion of premium to the policyholder. In the individual and small group markets, this threshold is 80% of premiums. So in other words, if insurers don't spend at least 80% of premiums on claims, they'll need to rebate a portion of the premium to the policyholder. Now, I admit I'm oversimplifying here. The MLR rules are actually a bit more complicated, but in general, that's how it works. Next, I'll turn to individual reinsurance, which could be used to reimburse plans for COVID-related claims and/or for especially costly claims. Government-provided reinsurance programs can be structured in different ways. They can be based on a dollar threshold, meaning that the government would pay all or a percentage of claims once an individual's annual claims exceed a predetermined threshold, such as $50,000 or $200,000. Or the program could be condition-based, in which the government pays for enrollees diagnosed with a particular condition. If reinsurance were implemented prior, or a government-funded reinsurance program were implemented prior to premiums being finalized, it could reduce premiums as the reinsurance would lower net claims paid by the insurers. In summary, one-sided risk corridors can protect insurers from unusually large losses due to COVID-19, and they could target payments to insurers with losses rather than providing payments to all insurers. So in other words, if no insurers have losses exceeding the threshold, the government wouldn't pay out any money through the risk corridor program. Two-sided risk corridors would also protect against unusually high insurer gains, with any insurer payments made to the government. Individual reinsurance can offset insurer costs for high-cost enrollees, and those payments would be made regardless of whether the insurer faced unexpected losses overall. In other words, it could increase gains to any insurers that are already experiencing lower claims than expected. MLR requirements could provide a backstop on unanticipated insurer gains under either a one-sided risk corridor or reinsurance. And MLR rebates, again, are paid to policyholders rather than the government. And finally, I just want to mention that risk mitigation efforts directed at insurers won't address other risks that are rising in the health system, including those related to declining enrollment in employer-sponsored insurance, increased pressures on state Medicaid programs, and declines in provider revenues. Here's a list of related Academy publications. Our discussion today focused on the first two, but I do want to point out that we have put out some information on COVID-19 and Medicaid, which is also listed here. In addition, we have a dedicated COVID-19 resources webpage. And now I'll turn it back to Audrey, who will moderate the Q&A. Audrey?
Great, thank you, Corey. Appreciate that. Now we'll move on to the Q&A. I would like to remind everyone to submit your questions via the Q&A feature on your screen. I'd also like to encourage you to respond to some polling questions that you'll see momentarily. We welcome your feedback on this briefing and any ideas you have for future webinars. So here is our first question. Preliminary premium rates are already being submitted, some even as early as April, I believe. Can risk corridors or reinsurance help even if these programs are implemented after final premiums are finalized?
So this is Corey. I think that question's for me. So either risk corridors or reinsurance could be implemented after premiums are finalized. So in fact, they can be implemented not only for 2021, but also for this year, for 2020. But they just wouldn't have an impact on premiums if they're put in place after premiums are finalized. So it kind of depends on what the goals of the mechanisms are. So I just want to kind of go through risk corridors and reinsurance here. So for thinking first about risk corridors, as I've noted, they're intended to mitigate unintended insurer losses or gains, and that can be done after the fact. If implemented prior to rates being finalized, risk corridors could have a small effect on premiums, again through lower risk charges or using less conservative assumptions. But of course, and that won't happen if implemented after the premiums are finalized. But I would argue that you don't implement risk corridors with the main goal of reducing premiums. There are other tools for that. And reinsurance is often one of those tools. So with respect to reinsurance, as I noted in my presentation, reinsurance can lower premiums because it lowers the amount of net claims that are paid by the insurer. And that effect would be lost if the reinsurance program were to be implemented after premiums are finalized.
Great. Okay, we've got another question. There's been new spikes of COVID-19 in over half the states, and so do you have any idea how that might affect the premium rates for 2021?
This is Barb. I can take that. So if insurers are seeing that wave one may be persisting into this year, they may be thinking that deferred care may be pushed to 2021. So this would tend to lead to an increase in rates. However, I would say that this is going to vary by region. We just heard that Texas is suspending some elective surgeries due to the situation in their state. So again, they are deferring care right now. So in that region, there may be an expectation that some of that deferred care will be pushed further into 2021. And it also depends on whether the states are allowing flexibility for the insurer to revise rates. I think many states are allowing this flexibility. So they may look to revise their rates for pent-up demand later this summer before their state's deadline. However, in looking at pent-up demand, pent-up demand typically isn't a large adjustment. The key will be whether they really have enough additional information to support the change, since things are changing from week to week. So even with additional information, they will have more information, but things have been changing so quickly that there's still going to be a lot of uncertainty when the rates by filings have to be closed.
Those are in August for the state exchanges and October for the federal exchanges. Is that correct?
Right, but states typically need the final rates, like for the federal exchange, earlier than the August date because they have to do the final sign-off. So typically a few weeks before the August deadline.
Here's another question on reinsurance. Aren't there already private reinsurance and state reinsurance programs? How would a new reinsurance program be different from and interact with these already existing programs?
So this is Corey again. Yeah, so that's absolutely correct. Private insurance is already available, both aggregate reinsurance and individual reinsurance. I'll focus on the individual reinsurance. I think one important difference to keep in mind between private reinsurance and a government type of reinsurance is that with private reinsurance, the insurance company or the employer plan has to pay premiums for the reinsurance, and those premiums flow through to the plan premiums. So you don't really get any big reduction in premiums due to the private reinsurance. In contrast, if a reinsurance plan is funded through the government or through other external sources, then the premiums could be reduced, again, as long as the program is created prior to premiums being finalized. One other thing to keep in mind about private reinsurance is that it's not done on a guaranteed issue basis. So reinsurers can deny offering reinsurance to groups as a whole or to individuals within that group. In terms of state reinsurance programs, yes, many states already have reinsurance programs as part of their 1332 waivers. As Barb noted, depending on how those programs are structured and funded, they might have less money than they expected this year and could reimburse plans less than expected. So in particular, if they relied on insurers' assessments, which would fall due to the economic downturn, that could reduce the reinsurance funding available. And I think something else just to keep in mind in terms of the state reinsurance programs, it would need to be specified how that would interact with a federal program. Would that federal program take precedence and pay the money out first, and then states could pay the remaining part? I think that's something that would need to be worked out.
Thank you. I understand that there is talk of a House voting on a bill, possibly as soon as next Monday, to enhance the Affordable Care Act. One of the provisions is related to prohibiting short-term plans. How would prohibiting short-term plans affect risk pools and premiums?
This is Barb. I can take that. So short-term plans are underwritten and many have limited benefits, so they appeal to healthier individuals, those who don't have pre-existing conditions. So if short-term plans were prohibited and their enrollees purchase in the ACA market, the risk pool could become healthier, which would have a downward effect on premiums.
Great. Another provision is related to increasing premium subsidies, as well as providing subsidies to those with income of 400% of poverty, of the federal poverty level. How would this affect risk pools and premiums?
Yeah, in general, increasing the affordability of the individual market could result in additional people enrolling in the market, which could improve the market risk composition and lead to lower premiums in the future. I would note that the size of the unsubsidized 400% plus enrollment decreased sharply since like around 2017 when premium increases were put into place. This indicates that the premiums are not affordable for the 400% plus segment. We also know that there are many people eligible for subsidies who choose not to buy. Assuming that these people are healthier than average, lower net premiums after subsidies could incent them to buy, and they would improve the risk pool.
This is Corey. I know, I'm sorry to butt in here, but I know that another provision in that bill would provide or funding for, I think, states to enact their own reinsurance program, and so I think this is separate from COVID, and this would be allowing, providing or facilitating other states to also create programs that do result in lower premiums. CMS just put something out this month, going through all of the the 1332 state-based reinsurance programs, and they include some information on how much premiums were reduced because of the reinsurance programs, and those were from 6% up to a 30% reduction in premium. So just building on what Barb was saying, when coverage is more affordable, that can increase enrollment and improve the risk pool profile of the insurer's population.
All right. We do have one more question, and let's see. How will the decline in office visits affect the diagnoses that are used in risk adjustment? Will this impact 2021 rates or premiums?
This is Barb. I can try to answer that question. So in the ACA markets, obviously all the issuers will be facing this decline in office visits and possibly getting less diagnoses. Since ACA risk adjustment is zero sum, if it affects all issuers equally, it may not have a big effect on the transfer amounts. It's possible it could affect more insurers differently than others. In this case, there might be a small impact. They would need to consider this when they're developing their 2021 premiums. So when an insurer develops their premiums, they are projecting their risk adjustment transfers as part of that. So, it could be a component in how they think about it as far as it affects their risk adjustment transfer.
Thank you, Barb. So that's all the questions that we have. I want to thank our speakers for sharing their time and expertise with us today, as well as thank all of you for participating in today's briefing. And I believe the poll is now closed, so thank you all for your feedback.